Evening, everyone. It's about 6 o'clock on Wednesday evening. This is your closing comment, video number 756. And, I've been spending a lot of time working on this stuff and trying to put out an awful lot of content for you and give you every possible opportunity to see, diverse and divergent points of view, like yesterday's Druckenmiller, excuse me, condensed video of the hour-long interview. And I only make that point because we really appreciate the support. If you like the work, if you find it helpful and useful, please hit that subscribe button, take the notifications so that you know when there's something new. But again, please hit that subscribe button. Okay, so it was a horrendous day. Not going to spend a lot of time on individual stocks. Most were terrible. But I believe that the chart on the screen right now is really the main chart. This is the daily of the bonds. I told you repeatedly how we continue to have these lower highs and lower lows. Let's go back and take a look. Longer term, we had the blow off, we had a break, we had a lower high, we had another consolidation and a break. Now we have a lower high. This is a monthly. You look at it on the weekly, you can see the same thing, except that this is a recurring pattern. Break, consolidation, move up to a lower high, break, consolidation, lower high, break, consolidation, lower high, break, break. Now, I talked about this last week and the week before, going back to the daily. It is really difficult for the market to really act well if we're going to have higher interest rates. And, as I've always said and still will always say, regardless of what the circumstance and the macro look is, positive or negative, sentiment runs the market. And sentiment can change on a dime. It's usually political or geopolitical. Frankly, I think inflation is partially a political issue. It is definitely a geopolitical issue. We also have very close to an all-out war brewing in Israel. We also continue to have, now that we've announced our departure from Afghanistan with a seemingly date certain, we now have real problems there. The cyber stuff is, as everybody knows, a really serious problem, and we've seen that. Colonial Pipeline says they think they have it solved and will start to open by the weekend. But, we'll have to see. I talked to people in New Jersey who live right on the edge of the biggest of the refinery areas there in southern Jersey, and their gas stations are literally out of fuel, and they only have to go 20 miles up the road. So, these are all problems. The CPI was a huge problem, and tomorrow we have PPI, which is the producer price index. I can't imagine that with commodity prices doing what they're doing, that could possibly come in any way, shape, or form in a positive manner. And frankly, I really hope that it doesn't. The worst thing that we could have in this market is a fake bounce without a complete blowout to the downside. I'd rather see the market down 600 tomorrow morning than up 200. And that's pretty much what we had last week. We had those bad numbers for the monthly employment. And here's what the bonds did. They went up $2.50 for a nanosecond. And they closed down on the day. And now, today, we were down another point and a third or so. So we've gone from over 160. We're basically 160 and a half all the way down to today's low and close to the close, 155. That $5 in bonds is a huge move. I know we're desensitized by it, but you know, these percentage moves are really meaningful. Okay, so I'm not going to go into all the CPI numbers. I'm sure that you've already seen them. They were 3 times worse than was expected. I also saw Mohammed Al-Arian on this afternoon talking about the Fed and inflation. And frankly, the guy said, you know, I hope, I mean, that's not a word that you use. That's not a plan. He hopes the Fed has it right. I don't know why he would say that. He's also said that that hope was no better than 50-50, that they do have it right. So hope at 1-to-1 is not a particularly good risk reward. And frankly, the Fed is rarely right. So I'm not terribly encouraged by that. What I am encouraged by, though, are a couple of things in a couple of stocks, but let's do the net changes first. So we were down just short of 700, 681 or 2% in the Dow. Not overwhelming, not much off the highs. NASDAQ, on the other hand, was down another 357 or almost 2.7%. The S&P, which, if you recall, I said at 42.25 was as extended off the 20-week moving average as it ever gets and needed to come down 4%. So today, it was down another 89 or 2.14%. The biggest loser again was the Russell, down almost 72, 3.25%, and the transports were down 2.3. I'm just going to go back and show you what that S&P chart looks like, because I think that it's pretty important since most people, key off it and everybody tries to outperform it. But here's what I was talking about. You see on the weekly, not the daily. The daily looks just exactly like the bonds look, and that's not really a surprise. On the weekly, you can see where we were on Friday's close up here, 42.25, and how far away we were from that rising and very reliable 20-week moving average. Now, we're 2/3 of the way there. I was looking for somewhere in the neighborhood of 4 to 6%. 42.25 Friday's close times 0.96, which would be a 4% decline, would take us to 40.56. Today's close, 40.58. That's pretty close for government work. And if we go to 5 or 6%, 42.25 times 0.94, then we have 39.71. So let's just round it to 4,000. 4,000 would be right here. Coincidentally, the last important breakout to the upside after another consolidation. So, we're pretty close on most of these things, and the market internals were pretty bad today. The advanced declines on the NYSE were 6.5 to 1 to the downside. The volume was also 6 to 1 on the downside. On the NASDAQ, we were 3 to 1 advanced declines, 3.6 to 1 in the volume. What was also interesting in the NASDAQ was that yesterday new highs, new lows were 6 to 1 to the downside, and today they were only 2 to 1 to the downside. And on the New York, they really have not been meaningful. They've been pretty close to 1 to 1, and the numbers are only double-digit numbers. So, 90 new highs and 76 new lows is not really meaningful. What was meaningful today was that the volume, although it was slightly lighter than yesterday, the period of 2 o'clock to 4 o'clock was substantially heavier than yesterday. And what really caught my attention was that from 3:30 to 4 o'clock today, the volume, the composite volume, so both the NYSE and the NASDAQ, was 30% higher as the market was accelerating to the downside. So we may get a bit of a washout if that PPI number comes out negative or worse than expected, and we do get another downdraft. There are a couple of stocks that I would consider buying. So let me just go to the stocks. I'm only going to look at a couple of them, and they are ARRY, which I mentioned this morning, which missed top and bottom and is really kind of the poster child for increased input costs. Their cost, it says technologies, but really it's consumer defensive, and they use a lot of steel and a lot of freight. So steel and freight are what really hurt the company. This morning, if you recall, it was 18 down 7 or 28%. As it turned out, 1830 turned out to be the high of the day, and it broke all the way down to 1322, closed 1369, down 45%, down 1126. So this is the look of the stocks that are reliant on the materials that the Fed says are causing transitory inflation. So we'll have to see. Okay, however, I do like stocks that have pricing power. So, of course, the P&G of the world, those kind of stocks are interesting because, number one, they're defensive, and number two, they're consumer non-durables and consumer staples, and people spend money on them regardless. They buy all of the toilet paper and tissues and shampoo and deodorant that they do regardless of what the market looks like. However, another one that I kind of like is Facebook. Facebook is down. It's actually not down, if you look at it, that much. It's only 10% from the high. But if you recall, this is where most of the social media advertising goes. And when you think about that, you look at a company like Facebook, which doesn't really have to borrow any money, doesn't really have the kind of cost of goods sold that involve buying and building anything. And when you look at it on a weekly basis, you see that it has really consolidated above the breakout to the new high. Now, again, only 10% off the high. I am not a proponent of, oh, well, it's down 5 or 10%, so you have to buy it. I'm not saying that at all. I'm just saying that this company has certain advantages that retail needs, and they execute incredibly well on it. Now, it's also, at today's close, last 303 down 16 or 5%. That's actually half the distance from that uh, from that recent new high to where we are now. We're also pretty close right here on a round number, 300. Everybody knows if this stock, stocks tend to be magnetized to the round numbers. Now, could we break to the downside? Absolutely. I mean, we're still pretty close to the upper Bollinger Band. We are neither overbought, terribly overbought, or oversold. We are oversold on a short-term basis, which you'd expect from a stock that in the last 3 days has gone from 331 to 298. It would deeply disturb me if the stock closed below this 290 area. But when you're looking at something like this, and my suggestion would be to buy options, not the stock, or buy the stock and use a stop below 296, which basically is $7. There aren't a lot of people who are buying thousands of shares of a $300 stock, certainly not individuals. But, if you wanted to buy it here and use today's low or the low here, which is the low for the last 8 days, or this close, which is 298.66, which is pretty close to today's actual low, on Friday, then I would say that is interesting. Another group that I think has really strong pricing power are the streaming companies. And my favorite one, as you know, having been long since it was in the 20s, was Viacom. We were long a lot of Viacom very early on, and we sold a bunch of it on the way up. We sold some here in the high 50s, 60s. We were nowhere near this, but we actually still own stock that we bought way back here. As a matter of fact, I'm just going to check and see. Our Viacom position cost $22.48. So at $39, we're still profitable. And we also did sell a bunch of it. 45, 50, 58. So we still have a position. It cost us here we sold some at 64.81. So we still have a small position. It essentially costs us absolutely nothing. And the streaming services seem to have some of the best pricing power of anyone. On a weekly basis, as you know, when the stock broke down on the Archegos deal, which had nothing whatsoever to do with the operations and the profitability of this company, we came straight down from 100 to 40. We've been consolidating on a weekly basis. We are also dramatically oversold on a weekly basis. On a daily basis, we are exactly the same. This one is close enough to the lows at 37.33 that if you buy it here at 39.05, you have a $2 risk in the stock. I don't think it's gapping to the downside again, even on the daily basis. It is oversold and has been oversold for a while. And so, this is another one that I like. The fact of the matter is there are buys in these kind of markets. I think, you have to keep your position size appropriate. We are going to have a rally. I don't know if it's going to be a strong enough rally or if we're going to resume the upside. sell in May and go away certainly looks like it worked a lot better this year than it has in 8 of the last 10. But, when something doesn't go the way it's supposed to in 8 out of 10 years, you got to say, maybe it's due. And clearly this was due. Okay, so the rest of the futures, just so that you know, I want to show you the gold because while it was down 13 and is down a little further tonight on the reopen, it really has not gotten terribly hurt. I mean, this is the weekly and it's been consolidating. Let's go to the daily. It's been consolidating, and really, even with the break today on the higher interest rates, we are still above the most recent breakout at 1800. We're trading 1815 tonight, which is down 7.5. So this doesn't scare me. We have a position in the silver, which looks very much like the gold. And I think, we are seeing the same kind of action consolidating of the last breakout right back to pretty close to the round number of 27. We're 27.13 down a dime. So this position doesn't really scare me. Many of our option followers sold half their position on the 100% up rule at 136. Some got as high as 146. Some didn't get any execution at all. But uh, I'm not terribly concerned about it. Bitcoin was down pretty hard today again, down 2,300, but I want to show you something there too. It's looks like it's lower again, but the bottom line on that is it is locked in this consolidation. I want to show it to you on the weekly because it's more important. After the blow off top and we came right back down almost to the 20-week area, we have been in this consolidation. Consolidation has a low of about 47,500 and a high of about 59,000, 60,000. So even today's move, even this week's move, is still within the bounds of a consolidation on something that has gone up since August, or let's look at the breakout, since October of last year, has moved from 12,000 to 60,000, 500%. So being in a consolidation, as it has in the past, consolidated here before breaking out to there, consolidated here before breaking out to there, consolidated here before breaking out and going from 18,000 to 40,000 in a matter of weeks. This is the way this trades. I am not negative on this at all, even though I am much more positive on Ethereum. But the fact of the matter is we use on both of these, we use GBTC, which has been lagging, but is the Grayscale Bitcoin Trust down at its lower Bollinger Band, has been dramatically outperformed ETHE by Ethereum. Remember, Ethereum overbought today with a high of 43 and change and a low of 36, closed about mid-range, and only down 80 cents on the day. Ethereum is much more commercially used. It is also the blockchain that the platform for which non fungible tokens, NFTs, are built. We had a big auction last night. We have another one tonight. Very successful auction of these NFTs. I think tonight's is at Christie's. This is a market that is blowing up, and Ethereum seems to be the way to go. And I've also made the point that Ethereum to Bitcoin is like silver is to gold. It's lower priced, it has solid potential, and they tend to move together in the same direction, even though, as I said, Ethereum is the catch-up play here because the Bitcoin is being outperformed by the Ethereum. All right, everyone. That's it for tonight. I will do tomorrow morning's pre-opening comment. I will discuss and give you the PPI numbers, but I'm having my second cataract surgery tomorrow, so I will only be in a half a day. There will be no closing comment, most likely, and there will definitely be no daily note tomorrow night. So I'll be back in the morning. I cannot implore you anymore. If you have not seen the Drunken Miller video, the link is on page 1 of tonight's note. Again, take the 10 minutes and watch it. And please, if you like the work, please hit that subscribe button. Have a good one.